Good morning, everybody. I hope you're having a wonderful day today. I know I am blessed for another day on the earth, so praise God for that. I wanted to make you a video today to kind of cover something I've covered a little bit in the past, but I've never laid it out this cleanly in terms of like the different qualification methods and the different loan options. Recently, I've had a lot of people come to me and say like, I don't show enough money on my tax returns. I can't qualify for anything. The truth in that, it's entirely false, right? A lot of the big retail lenders and the big box lenders, they push this out that there's only 4 loan options, right? Conventional, FHA, VA, and USDA. And if you don't fall in one of those buckets, you can't buy a house. I'm here to say that is very, very, very far from true. The alternative doc loan options don't come with a 0% down. They don't come with 3% down. If you compare apples to apples, the pros and the cons of home financing strategy, you'll find that, especially if you're self-employed or you're a real estate investor, the majority of the time, these are better loan options for you. Super crucial you find somebody that you know, trust, and love to represent you in these alternative doc loans and somebody who knows what they're doing. If you want that to be me, I'd love to have a conversation. Give me a call at 919-896-0318. Let's dive into it. All right, so I've created this very simple flowchart, right? That's going to help break down maybe what option would be best based on your scenario. So if you want to take a picture of it, screenshot it, whatever that may be, reference this when you're looking over your financing options, right? So this is primarily going to go to if you're self-employed. I put or alternative doc. Also, if you're a real estate investor, we'll touch kind of that in the end, right? The beginning of this is going to be really focused on primary residence. So speaking to a primary residence, right? If you're self-employed, first and foremost, do you qualify with your tax returns? Some people take advantage of more write-offs than other people. Some people actually show substantial income on their tax returns, right? And so do you qualify with tax returns? The best loan terms you're going to get are the big 4. That's not to say it's always the best thing for you, given your certain business situation, right? But that being said, if you qualify off of your tax returns, these are going to be one of your best options, right? I would always tell you to go conventional on a primary or VA on a primary before I would tell you to do one of these if your tax returns fit the bucket. A lot of people are really guilty of filing their tax returns to take advantage of their tax write-offs, but then they find out it doesn't fit the bucket. And next thing you know, they want to amend it and they want to do all these things. It's going to result in them paying tens and tens of thousands of dollars to the IRS. It's not needed, right? It's actually big picture, not smart to do that. And like, I know if you want to use your VA benefit, but you show $8,000 on your taxes last year, right? You also didn't pay any taxes, right? So there's going to be a big implication to showing 150 grand or whatever the number may be. Is that worth you qualifying for a house? Versus if you do a different alternative doc loan option, instead of giving that money to the IRS, you put it into the equity of your home. I've done previous videos breaking down the exact numbers on that. So qualifying tax returns, use one of our big 4. If the big 4 does not work, meaning you can't qualify for your tax returns, let's focus on how long have you been self-employed. So either way, on these, you need 2 years. However, on these, there is a couple of more lenient option. First and foremost, if you've been self-employed for less than 12 months, you are pretty much going to have no effective income for qualification purposes. Guys, that's because so many businesses fail in the first 2 years, right? So the lender wants to see you establish a business, grow that business, and keep it. So in the first 12 months, you're not going to have any effective income. We won't be able to use any of that for underwriting. Now, that being said, there is an option, which I do a couple of these every year, called a community loan. It is a no income, no employment loan for a primary residence. For the purpose that they serve, it's an incredible, incredible product. That being said, down payment is higher, minimum 20%, with significant reserves. I believe the last guideline was 6 months of reserves. Some of them, I think there's one other lender that does it, they do 12 months. The rate, much, much, much higher. I can tell you, even with good credit at 20% down, you're looking at probably like an 8 to 9 something percent rate right now. Again, this is July of 2026. It's always going to be significantly higher because it's such a bigger risk to the lender. Now, that being said, the great part about all of these options is the rate is very dependent on how much you put down, right? So lower risk to the lender because they have equity. or they're under leveraged, the better rate they're going to give you. But that is your only option if you have not been self-employed for less than 12 months. If you have been self-employed for 12 to 24 months, and I would say anything above 12 months, you do have other options at that point. Then we would go and we would ask, how do you receive your income? If you're a true business owner, most of the time you're getting it off of your bank statement. If you receive money only from bank statements, we would look at a business bank statement loan or a P&L loan. We can do a personal bank statement loan if that's how you get your income in. What that would look like is we take the most recent 12 or most recent 24 months of bank statements. You would add up all of the deposits together. You would divide that by 12 or 24, depending on how much statements you had to get that average. And then they would give it a standard 50% hit in order to find that expense ratio to find your gross qualifying income. Now, that being said, if you have a different expense ratio and your tax preparer or CPA is willing to write a letter saying, hey, they have a different expense ratio, you can do that. Most CPAs are absolutely horrified to submit anything like that. They run a million miles away. It is a challenging thing to get. I like the standard 50%. Where does that come into play? I've got friends that, have been blessed with business of $2-3 million, right? And on paper, they make $12,000 by the time it's all said and done. They have a fantastic CPA. So that being said, they wouldn't qualify for anything on paper the traditional way, but on business bank statement, $2 million in gross deposits a year is $1 million after the expense ratio. They're qualifying off $83,000 in monthly qualifying income. They can buy whatever they want, right? The other option would be 1099. Now, the big difference, 1099, you would just submit your 1099s. You do need between 1 and 3 bank statements to show that that amount is still coming in, right? But your 1099, if it's in your personal name, you can do it with as little as a 10% expense ratio to it. So let's say you make 200 grand a year in 1099 income, you could qualify with 180,000. So long as you have the 1099 and you do have the bank statements to back up approximately $200,000 a year coming into those bank accounts for a couple of months. All really, really good options. I see this with realtors a lot. This is a really good option for them. Again, if you choose to go 10% down on either of these, which is the minimum, you are going to have a significantly higher rate than if you went 15 or 20. And when you start to get below 20, 25% down, the rate gets really sweet. Some of these I do at the same rate as VA loans at 30% down, right? And it's also, there's a lot of different credit buckets. The 680 credit score is actually kind of on the lower end for these. You have lenders, I think that 660, 640 is the lowest they go, but the rate is going to get a lot uglier. So higher credit is definitely going to help. And then a couple of other methods that you could use, right? I've done this one primarily for like an elderly person, right? Asset utilization, which is basically taking the money that's available after down payment, closing costs, and reserves, and then doing a 60 to 84 month division of that number to get the qualifying income, right? Every lender is a little bit different on that. However, for people that have a ton of cash, but just don't show any income on paper, it's a good way to qualify, again, for a primary residence, right? And then moving on to investment, again, not for a primary, right? My favorite loan program under the sun, other than VA, is DSCR, debt service coverage ratio. That is taking the total of the rental and dividing it by the total cost of the mortgage, principal, interest, taxes, insurance, and association dues of that property to come with a ratio. Now, the goal is to get the ratio over 1. The higher over 1, the stronger the property, the better the rate. The more down payment, the better the rate. But there's no limit to how many you can buy, like how conventional has a limit, and it doesn't take into account your personal income whatsoever. I've done these for people who are unemployed. I've done these for people who only do real estate investment and don't have a traditional job whatsoever. You never have to ask employment or anything like that, right? And then for national is a very similar thing to DSCR, except it's especially for people who live out of the country but want to buy US-based real estate. They don't need any credit score to report whatsoever. And in fact, if they don't have one, it's almost easier. It's going to base it off of a 680 FICO for most lenders, right? And then as long as they have 25% to put down and 6 months of reserves, they can buy that property, right? Without even having to be in the country. Really good program there. It's a super easy loan to do if you guys have never done one, but hopefully loan officers that'll help you expand your clientele too. So anyway, here's some alternative doc options for you. I have been blessed to do a ton of 1099, bank statement, DSCR. Those are very, very, very much a heavy part of my business. I can talk through them with you guys in as much detail as you need, and I can give you great guidance in terms of the types of properties and different things that are easier and harder to acquire with those loans. So if you guys have any questions about that, give me a call, shoot me a text, and thanks for listening. Have a great day.